Hey you, welcome to today's backtest and also happy new month. So it's been a while since I did my last backtest. I think it's been 2 weeks now since I made a video. So today's backtest is going to be on um 31st of March. Okay, this move up, this run up on the 31st of March. That's yesterday. And looking at the daily charts on US100 on Nasdaq, you can see price has traded down to take out this, to trade down below this relative equal lows, okay, where sell side liquidity, sell stops lies, and it has taken out the sell side liquidity and is currently rallying up. So yesterday started the rally up in price. That was 31st of March, the last day of March. So let's get into it. So this was what brought about the whole rally up in price. So if you notice something, okay, there is there is a low here and there is another low right here. Okay, these are relative equal lows. Okay, but price didn't trade below these relative equal lows to take out sell side liquidity before this rally up in price. Now there's something going on in price. Obviously, there's something going on in price which less informed traders are not aware of. So traders who trade with smart money concepts and who understand how it works, okay, understand what's going on in price. So the Nasdaq, S&P 500, and the Dow Jones, they are all relative. They are all related markets. That is, they move in the same direction. They are positively correlated. Okay. So overall, the overall trend of these markets are moving in the same direction. Okay, overall they move in the same direction, but sometimes they can be slight changes. They can be changing direction sometimes. Okay, before going in the same direction. What do I mean by that? Sometimes there might be a divergence between these three indices. Okay, so this US100, which is the CFD for Nasdaq, and this is the CFD for S&P US 500. And you see, same thing has happened on the Nasdaq is also happened on the S&P. Okay, now price didn't take out this sell side liquidity before this rally up. You can see the rally up, it's a very long rally up. But on the Dow Jones, this is the CFD for Dow Jones US 30. On the Dow Jones, we can see, okay, wait for it to load. On the Dow Jones, we can see price trades below this sell side liquidity, okay, even twice before the rally up. Which brings us to the main talk for today, which is intermarket divergence. Intermarket divergence concerning Nasdaq, S&P 500, and the Dow Jones. So for the fact you don't trade S&P 500 or the Dow Jones doesn't mean you can't use this knowledge or this concept. Okay, like for me, I only trade Nasdaq. I don't trade. I seldomly trade S&P 500, and I don't trade Dow Jones at all. Okay, so and I can make use of this type, and I can make use of this knowledge into market divergence using that to trade Nasdaq. So first off, what's the divergence? Okay, get your books and your paper ready, and I would advise you jot down some of this stuff. What's divergence? Okay, in general, divergence is when two things move in different direction or behave differently at the same time. Okay, so they move in different direction, behave differently and the keyword at the same time. Okay, it happens at the same time. So what's intermarket divergence? Okay, intermarket divergence is when two or more related markets such as Nasdaq, S&P, Dow Jones, these are related markets. Okay, when two or more related markets move in different directions or behave differently at the same time. I'll repeat, intermarket divergence is when two or more related markets move in different directions or behave differently at the same time. Now, you see these lows right here. This is the Dow Jones, okay? The CFD for Dow Jones US 30. Let's just call it Dow Jones to avoid confusion. Okay, so this is the Dow Jones. These lows right here were created during the London session yesterday. Okay, so this is around 1 a.m. and this is around 3 a.m. right? And we see price trades took out these lows at what time? At around 6 a.m. Now let's go to the one for S&P 500. Okay, this is the one for S&P 500. Now you see these lows. This was created when? Around 1 a.m. This around 3 a.m. And this low, which couldn't break through, was formed around 6 a.m. Same time, right? It's happening at the same time. Okay, when two or more related markets move in different directions or behave differently, now they are behaving differently. The uh, Dow Jones and the S&P are behaving differently, and it's happening at the same time. Okay, also the Nasdaq as well. This is one for the Nasdaq. Now these lows were created during the London session. This one at 1 a.m. This one at 3 a.m. and this one which couldn't break through at 6 a.m. Now, if you notice something, the Nasdaq and the S&P are behaving the same. Okay, why the Dow Jones is doing a different thing, is behaving differently from the Nasdaq and S&P 500. Nasdaq made is making higher highs. S&P 500 also is making higher highs at this particular time. Okay, not trading below this sell side liquidity. But the Dow Jones made a lower low, okay, before the rally up. Now that's the intermarket divergence I'm talking about. Now, a divergence can hint at a potential reversal or shift in direction. So it hints towards a possible reversal or change in direction in price. Now, the Nasdaq, S&P, and Dow Jones, okay, these three indices usually move together. So when one behaves differently, it gives us the information of a divergence taking place. This kind of divergence suggests that institutional or smart money are active in the marketplace. Okay, so it suggests that institutional or smart money, or we can say it suggests institutional or smart money activity in the marketplace. Now, let's take an example. Okay, so if the Nasdaq, this is an example, okay, from the charts. I'm going to give the example from what we have here. So this is Nasdaq. If the Nasdaq fails to make a lower low, okay, so this is Nasdaq, it fails to make what? A lower low. That's to break through these lows. It fails to make a lower low. Then also, if the S&P also fails to make a lower low, okay, as you can see on the S&P on our chart, it fails to make a lower low, right? But the Dow Jones does make a lower low. Okay, so the Dow Jones makes a lower low. So the Nasdaq fails to make a lower low. The S&P fails to make a lower low, but the Dow Jones does make a lower low. Okay, this gives us the information of a divergence taking place in the market and is also hinting towards a potential reversal or shift in direction. Now, note something. The Dow Jones trades down, okay, to grab sell side liquidity by making a lower low, while the Nasdaq and the S&P are holding strength by failing to make the Nasdaq and the S&P, okay, they are holding strength by failing to make lower low in price. So when you see this and when you are able to identify this divergence in price, okay, this is the market quietly showing us that selling pressure is weakening. And also the move down on the Dow Jones was not a weak the move down on the Dow Jones was not a real weakness, okay? The move down of the Dow Jones is a Judas swing. It's a false movement, a false breakout down to trick traders in going short. So at first on the Nasdaq, why while I was looking at the charts at first, I was waiting for price to trade down, okay, while price was still forming at this range, okay. I was waiting for price to trade down to take out the sell side liquidity. That's why I got it labeled. Okay, I was waiting for price to take out the sell side liquidity. Then I checked the S&P 500. Okay, it was same thing. Okay, price was still here to take out the sell side liquidity, to take out these relative equal lows. So price was still here to take out the sell side, to take out this relative equal lows on the S&P. Okay, but when I checked the Dow Jones, price has already traded down. Where's the Dow Jones? Okay, why when I checked the Dow Jones at this time, okay, price has already traded down to take out the sell side liquidity on the Dow Jones. Okay, then I suspected, okay, maybe a divergence is taking place in price. But you getting the hints that a divergence is about to take place or is taking place in price, that's not enough. Okay, that's not enough confirmation to enter a trade. Okay, so here's the caution: don't take don't trade divergence alone. Okay, wait for confirmation, like in this case a strong move up, a strong surge up such as this, okay, and also a break of structure. Okay, so we can we can relate that to the Nasdaq. Okay, so if I know, okay, that okay, the Nasdaq faced to make a lower low, the S&P also faced to make a lower low, but the Dow Jones has traded below its lows. Okay, the Dow Jones made the lower low, and I saw this surge up in price. Okay, no, not the surge up, and I suspect that okay, a divergence might be taking play in price right now. Okay, that's not enough for me to buy this market. Okay, until I see this run up in price. Okay, that's a good confirmation. This strong run up in price, a strong move up, and also a shift in market structure. What's a shift in market structure? Why this rally up? Okay, when price trades above this high right here, that's a shift in market structure. Okay, so when I see this shift in market structure, like this. Okay, so when I see this shift in market structure, this is a confirmation that the divergence is actually taking place in price. So at the same time, where we see this shift in market structure on the Nasdaq, we can also see it on the S&P happening at the same time. Okay, this is 7 a.m. candle on the Nasdaq. 7 a.m. candle. Okay, 7 a.m. there was a shift in market structure. Let's see on the S&P on the Dow Jones. Also 7 a.m. there was a shift in market structure. Okay, and now on the Nasdaq we can see a fair value gap after this sudden surge up in price. and the shift in market structure. You can see this fair value gap on the 15-minute time frame. Okay, this is the fair value gap. It's looking a bit thick. It is okay. Okay, so you can confidently place a buy stop right here at the top of this fair value gap. Okay, not worrying if price would run down to take out this sell side liquidity. Okay, because a divergence has actually taken place in price. So if you've watched this video to this point, I really appreciate you. And you understand to some point, but you don't really understand, okay, fully. You can just continue watching the video, watch to the end, and you can always come back to the video. Okay, so that's how you learn. Okay, you learn with repetition. Okay, so once you once you are done with the video, okay, you can set another day or another time to come back to the video and watch the video, pay close attention, and also on the notes I gave, you can also jot down. Okay, so you have full understanding of this. So now at 8 a.m. the market traded down into this fair value gap. Okay, and the rally up started. This rally up, it's a very long rally up. Okay, so let's say you missed the trade right here. Okay, you were unsure if price would rally down to take out this sell side. Let's say you can't identify divergence. Okay, and price is already rallying up. Okay, so another point where you can enter this trade. Okay, now you see this down close candles followed by this up close candle. Okay, this is an order block. Okay, so the moment this up close, these down close candles, they are order blocks. So the moment this up close candle trades and close above this down close candle, it validates it as another block, this series of down close candles. Okay, and you see price trading down into them and respecting them. So price trades into the other block beautifully and rally up, a strong rally up. Okay. Also, we can see buy side liquidity right here. These eyes, this eye followed by this eye. These are relative equal eyes, and this is buy side liquidity, which price took out slightly. Okay. Also, there is also another order block. This down close candle with a series of up close candles. Okay, so this down close candle is another block, and you see it's an order block, and you see price trading down into it, respecting it without violating it. That's trading below this low. Okay, so this is another order block and another point of entry in case you miss this one or you miss this one. Okay, you can enter your trade. Yeah. Okay, why price traded down into this other block. And also after this rally up in price, okay, after this during this rally up in price also created a third order block. See this down close candle, that's 10:45, followed by this is a 15-minute chart, by the way. Okay, so you can go to your chart and do your own back test as well. So you see this down close candle at 10:45. Also, your time zone should be set at New York. Okay, New York time zone. This is mine. Mine is set to New York to get this correctly. So if your time zone is set to New York, this particular down close candle, this is 10:45 a.m. at the 15-minute chart, and it's followed by this up close candle. So the moment this up close candle trades and closes above the open of this down close candle, validates it as an order block. So this is another block, and price trades down into it beautifully and rallies up above, finally took out the buy side properly. Okay, you see how it surges up through the buy side liquidity, traded through it like knife through butter and into this 4-hour CB. Okay, so this is a 15-minute chart. Let's see how the 4-hour CB looks. So this is the 4 hour CB. Okay, this is the 4 hour CB. Sell side imbalance, buy side inefficiency. Okay, that's it. So at this range, only sell side delivery was offered. And here's what price normally do. Price will then offer buy side delivery. Okay, to make it balance, to rebalance itself. And you can also take your profits at this bearish order block. There's a bearish order block right here. This up close candle followed by the series of down close candle. So this is a bearish order block. So you can take your profits at this point also. But price actually traded above the bearish order block into another, into a bigger imbalance. Okay. So what's imbalance? I think this is the daily. This is an imbalance on the daily chart. Okay, exactly. Okay, so this is a daily CB, 1 day CB, as I annotated here. And you see price trading into it as well. Okay, so price would always want to trade into this inefficiency. Okay, once price is on a run up or down. Okay, that's what price does. So when price is running up, it goes to attack buy side liquidity in form of highs. Okay, and also it rallies to inefficiencies, imbalance. Okay, and also the other block as well. Price also rallies up to other block. Same thing for why price is rallying down. Okay, why price is why price is rallying down, it goes to attack sell side liquidity in form of lows, old lows, and also it goes to it goes to inefficiency, imbalances below price, and also your other block as well below price. So let's see how the risk to reward ratio for this type of trade would look like if you actually enter the wave. Okay, so this is Nasdaq, how the risk to rewards would be like. So let's say you enter the long at this fair value gap. Okay, you were able to identify the divergence in price, and after this run up in this break of structure, okay, you placed a buy stops, a buy limits, okay, at this point, and your stop loss is somewhere here at these lows. Okay, so you're able to hold this trade up to this 4 hour CB. Okay, that's about 3.9 risk to reward, almost 4 risk to reward. Even at the buy side, it's 2.8 risk to reward. Very good risk to reward. And if you're able to hold this for the whole day while it trades into this daily CB, that's a 7 risk to reward. Very massive. Very, very massive. So let's say you miss this and you use the other block, this other block, and your stop loss, it's at this point. Okay. At the at the buy sides, at the buy side, you get about 2.8 risk to reward. Okay, while using this other block as your entry. Then at the 4 hour CB, you get about 3.9 risk to reward. It's almost the same thing as trading below. And if you can hold this for the whole day, that's about 8 risks to reward, even more massive. And also, we also have the second order block right here. Okay, so if you are using the second order block, your stop loss will be at this low. Okay, so this to the buy side is about 2 risks to reward, 2.5, 4 hour CB, 3.6 risks to reward, and holding it for the whole day, 8.5 risks to reward. That's a very good trade. So I hope you found this insightful. Also, if you are new, you can follow up with the ICT 2022 playlist of mine, which will be displayed on the screen. Okay, so you can follow up with that, the ICT 2022 mentorship. You can follow up from the first video And I promise you, as you continue to watch further, it's only going to get better. Okay, so I'm trying my best to touch different areas on the ICT 2022 mentorship model, and also to do backtests on different scenarios. Okay, so you can be able to so you can be able to trade this model really really well. Okay, no matter the conditions of the market. Like for those who do not know about divergence, okay, they'll be waiting for a rally down in price to take out sell side liquidity. Meanwhile, it has already done that on the Dow Jones indices. So stay tuned for more amazing backtests. Turn that notification button on and subscribe to the channel. Until next time, have a lovely month.